What if I told you that the most innovative and the hottest new company in a booming industry collapsed like a house of cards in a matter of days? This sounds impossible, and yet it happened. This is the story of Wirecard. Wirecard is an online payment company which has over 5,000 employees, and it has operations pretty much around the world. Just a few days ago, it was valued at $17.5 billion. But now, it just got downgraded to junk by Moody's, just like that. What happened? What happened with Wirecard? Wirecard is a company that was 2 years ahead of Amazon with a fully working, no checkout store. This is a German company that proved everybody wrong. It proved that Germans are not only good at building cars or engineering. This was a miracle, a global phenomenon. But now it's going up in flames, and the story of what actually happened with Wirecard is gonna blow your mind beyond your wildest dreams. The COVID-19 pandemic caused a massive disruption across every industry you can imagine, for better or worse. And while some industries like airlines and car rentals are disintegrating before our very eyes, the online payment industry is blowing up to new levels during the pandemic. The health concerns around using cash is pushing more and more customers to online payment apps and systems. By 2023, the online payment market is expected to reach a record high of $125 billion, which is more than double of the market value in 2018. But even in the wake of this massive online payment explosion, one online payment company is not doing so hot. This is the story of Wirecard. Now, this would have made sense if Wirecard was a failing company, but it is quite the opposite. Wirecard was the hottest company in the online payment market. So how a successful company in a booming industry is collapsing in a matter of days? Here's what happened. Wirecard has literally lost $2 billion. And when I say lost, I don't mean it in the accounting business way, as in losses and profits. I mean literally lost, misplaced, like a set of keys or a wallet, which nobody at the company seems to be able to find, including Mr. Markus Braun, the founder and the CEO of the company. The collapse of Wirecard happened almost immediately. On Friday, June 20th, Markus Braun resigned as the CEO, which somehow was not the worst thing that hit the company that same day. A few hours later, Moody's slashed the company's rating to junk, and its share price plummeted by 80%. By the end of the day, Wirecard stock was trading at a €20 price, which was a far cry from the €200 price it had in late 2018. So what happened? How did the poster child of German tech companies just misplace $2 billion? In order for us to understand what really happened, we have to completely recreate the timeline. January 30, 2019. The Financial Times published an article about Wirecard. In this article, they quote a whistleblower claiming that the entire company valuation of Wirecard is completely based on a web of sham transactions. Basically, the whistleblower and the article were claiming that the company was recording sales that never took place. Initially, those allegations seemed far-fetched, and at that point, there was nothing there. These were rumors barely making the news. However, the Financial Times kept running with it. In fact, they published a number of follow-up articles talking about transactions with clients in Dubai and Ireland that were not traceable. That was enough to turn the heat on Wirecard management to react. On October 31st, 2019, Wirecard hired an external auditor to look into these allegations and clear its name. This led to a 6-month investigation, and on April 27, 2020, the company realized that KPMG, one of the largest 4 auditing companies in the world, which was hired by Wirecard to fix the problem, was not going to play ball. They simply could not. What they found was insane. They had no choice but to speak up. The outcome of that investigation was mind-blowing. KPMG stated that it was unable to verify whether the main business line of the company, which was responsible for the lion's share of Wirecard's operating profit, ever existed to begin with. KPMG were using accountant lingo to pretty much say that they don't think that the company's business was even real. What KPMG found was quite astonishing. This was a scam on a global level, involving billions of dollars and multiple countries and continents. So here's what happened. Half of the revenue of Wirecard and 90% of its profits came from 3 clients only, which somehow never paid Wirecard. And besides that, a subsidiary company of Wirecard was clocking 600 million euros on the books from clients based on transactions that never led to actual payments. No cash was flowing in parallel to these deals as well. Another subsidiary was paying Wirecard 350 million euros for 34 different client transactions, but the cash never got received by Wirecard. So essentially, what KPMG found is that Wirecard was reporting income and revenue that never existed on a massive, never-seen-before scale, making it seem much more than it really was, essentially lying about $2 billion of fake income. This scam worked in a very simple manner. The company would essentially record the sale on the books, following an invoice which will be issued to the client. Then Wirecard would report the income on its financials and keep doing it again and again. The hack that they used to pull it off was an accounting trick. The income was registered today, even if the payment is due months away. And they kept on doing it, but that payment never came. Eventually, KPMG managed to trace the money into 2 Philippines-based banks. The company literally showed KPMG bank statements to prove that the money was in those accounts. Initially, that was the end of that. But funny enough, once the KPMG report became public, something very crazy happened. Both banks came out and said that the official statements showed by the company are complete sham. They denied any involvement with Wirecard, stating that the documents presented by Wirecard claiming the existence of a Wirecard account in their bank is fake and carries forged signatures of bank officers. Not only that, the banks also said that Wirecard was never even a client of either of these banks. Those are pretty wild accusations. On May 3rd, 2020, a week after the KPMG report, Wirecard tried to contain the event by publishing their own response to the report. In the Wirecard response, however, the company claimed that based on their interpretation of the KPMG forensic audit, KPMG was able to prove beyond any reasonable doubt the existence of 97% of the clients, a claim that was never made by KPMG. The KPMG report not only didn't say that, it actually stated that the use of contracts with clients without any substance and without any economic purpose was apparent, and KPMG was not able to understand what was the purpose of these agreements. Now, this is pretty much KPMG's way to say that Wirecard were pretty much padding their profits with fake client contracts. In fact, the main conclusion from the KPMG report was that KPMG could not verify that a large portion of Wirecard revenues were ever genuine. 10 days later, on May 13th, the German Federal Financial Supervisory Authority launched their own investigation into the Wirecard market and stock price manipulation case. Same day, Wirecard was hit by another bombshell. On May 13th, a lawyer named Andreas Stelp, one of Germany's most prominent securities lawyers, and the lawyer who led the $10 billion legal lawsuit against Volkswagen, filed a lawsuit against Wirecard, essentially claiming that Wirecard was lying to its investors. Things were about to get worse. This was not the worst of it. A company in the Middle East by the name of Al-Alam Solutions, a Dubai company, which was central to this whole case, has announced its liquidation. This was a major event, since Al-Alam pretty much was Wirecard's most significant business partner. LLM was a Dubai payment processor to which Wirecard referred customers and collected fees. Here's the funny part. It literally dissolved itself 5 days after the KPMG report came out. 4 days later, Wirecard itself announced that it's going to liquidate its own Middle East company called Card Systems Middle East. Now, Card Systems was Wirecard's largest and most profitable unit in recent years. According to KPMG, almost all of the revenues of Card Systems and 2 other large Wirecard businesses came from referring clients, which was essentially payment processing clients, to 3 third parties. And guess who was the biggest one of these 3? Al-Alam. Yes, in fact, Al-Alam was the largest of those 3, even though it appeared to operate from a broom closet with 6 employees somewhere in the desert. This gets even weirder. The arrangement with Al-Alam and the other 2 clients contributed to the lion's share of the 985 million euros of operating profit which Wirecard reported on its financials from 2016 to 2018. But $1 billion of payments from these partners went into accounts which were not controlled by Wirecard. KPMG actually failed to obtain any statements for these accounts and could not verify where was the source or the current location of these 1 billion euros. Now, 2 days later, on May 15th, Deutsche Bank actually announced that it's suspending its investment recommendation on Wirecard stock, which it kept recommending for months before that. This was a major event, but not the worst. On June 7th, Wirecard had to throw a Hail Mary to try and save its business. The company released a statement claiming that the regulatory investigations which are being conducted are directed at the individual members of the board and not the company, and that the publication of the consolidated financial statements that were supposed to come out on June 18th are going to clear up everything and is going to make it clear. So Wirecard needed the financial reports to go out on June 18th on time to calm the turmoil down. 2 days later, something even crazier happened that nobody anticipated. A massive hacker group called Dark Basin got exposed for running a hack-for-hire service for high-end clients. Now, these were not amateurs. These were pros that targeted thousands of individuals and hundreds of institutions for years. Targets included advocacy groups, journalists, politicians, senior government officials, hedge funds, and multiple industries. Now, here's the kicker. The most prominent targeting of the entire financial sector was concerned with journalists and investigators working on the Wirecard case. That hack led to private emails from multiple journalists becoming public as part of a leak's website. However, it was actually uncovered that these stolen emails were misleadingly edited and presented before being posted on these leaks websites, essentially to present Wirecard in a more favorable manner. Now, it seemed like a coordinated corporate attack with a high degree of sophistication. Everything pointed out that this group was hired by a high-end client to attack people who are covering the Wirecard case. Now, there is no proof that Wirecard had anything to do with these attacks. However, everybody in the community, especially in the financial community, believed that they had something to do with it. And with that was the beginning of the end. Finally, it all came down to June 18th. Remember that date? Everybody was waiting for the Wirecard financials to come out. But this was not to be. On June 18th, EY, the auditors, said that they are not able to issue the financial reports because they could not confirm the existence of $2 billion on the cash balance. This, of course, was a death blow to Wirecard. And as Wirecard stock tumbled down, and as the founder and CEO quit, the company finally admitted that these $2 billion never existed.